Good morning and welcome everyone. Today is the third day of Edelweiss Emerging Ideas Conference 2020. And I thank all the stakeholders for an amazing response in the first 2 days. We had some insightful discussions ranging from modern monetary theory, equity valuations, contrarian investing, sector rotation, behavioral finance, and of course, banking. Today, it's time to get some insights on global macros and some exciting ideas on precious metals. I have the privilege to introduce Tavi Costa to you today from Crescat Capital. Tavi is a portfolio manager at Crescat and has been with the firm for the last 6 years. Tavi built Crescat's macro model that identifies the current stage of US economic cycle through a combination of 16 factors. His research has been featured in financial publications such as Bloomberg, the Wall Street Journal, CNN, Financial Post, and whole host of services. Tavi is a native of Sao Paulo, Brazil, and is fluent in Portuguese, Spanish, and English. Before joining Crescat, he worked with the underwriting of financial products and in international business at Bray Service, a large logistics company in Brazil. Tavi graduated cum laude from Lindenwood University in St. Louis with a BA degree in business administration. Tavi played NCAA Division I tennis for Liberty University. Tavi is known to present some excellent ideas through some really amazing charts. Crescat Capital has been one of the best performing macro hedge fund this year, and we are eager to hear Tavi. Good morning and welcome, Tavi. Can you take us through some of your profile and talk us through about Crescat right now?
All right. Well, thanks for having me here in this presentation. It's a pleasure to be here. Happy to be discussing some of our views about what's going on with the macro world. At Crescat Capital, we're a macro fund, so we manage about 5 products today. We have global macro hedge fund, long short hedge fund, and a precious metals hedge fund. The others are just SMAs. We've had mostly of investment process is focused on quantitative models in the fundamental side and the macro side. And it's not a systematic strategy. We are a discretionary macro fund where we use our models to really guide us in developing macro themes. Today, we have 3 major themes in the portfolio, one of them being the China credit bubble, and the second one being the possible decline of the business cycle here in the US, and the third one being precious metals as the most opportunistic side of on the long side of the equity market. So I'm happy to be here. Thanks for having me. And should I start my presentation now? Would that work for you? Let me share my screen.
I think a few themes that you've been talking about lately, the overvaluation of US equities, the growing debt pile in China, and the opportunity in precious metals. I think these are some of the themes that you've been talking about lately. So take us through your thoughts, and probably we'll come back and have some questions from the audience and interact with you. So over to you now.
All right, great. I'm going to try to go as quick as possible. I have a lot of charts in it, but I think most of them are all important. Let's start from the big picture and stepping back and seeing all the way from the 70s what happened with the US, especially in terms of the national debt relative to GDP. The red line here is just nominal debt, and the white line is just nominal GDP. And those 2 lines are normalized going back to the 70s. It's actually going back to 71, which was also the time when we broke the gold standard. And that was a time when it really began to have this fiscal indiscipline in general that we had in the US, along with the growth of that was actually outpacing the levels of growth in the economy. Especially recently, if you look in this chart right here after 2009 or so, after the global financial crisis, this was really when we saw this ramp up in debt relative to growth in the economy. And this, in my view, is a long-standing issue that will have it will create tremendous opportunities, but also a lot of issues in the economy going forward. This is Crescat's, one of Crescat's macro model that is using about 16 factors to calculate and see where we are in terms of the of the macro scenario. And the idea is to give a score to where we are in terms of the business cycle. And the right line is just the S&P 500. This red line has done pretty well, finding where we were in the housing bubble and the tech bubble, in acknowledging where we were in the late stage. But right now we have what I call the great disconnect, where a lot of the macro indicators are certainly very depressed, but you see still valuations at all-time highs. I think that has created a very high dependency of central banks' interventions and governments in general. And here in this chart, it's just looking at global central bank assets that now surge to over 28 trillion for the first time in history. And this is accumulated in the Federal Reserve, the ECB, the BOJ, the Bank of Canada, the RBA, and the PBOC. So $28 trillion of increase. And again, this is going to give some major implications in the global economy as we go into this. One of the things that we've saw so far is really a speculative mode in the equity market here in the US. When we calculate valuations, this is just another model that we used by using about 15 factors in this case. And the idea here is to not only look at market cap weighted factors, but also using median factors. I think median factors are way worse than the market cap weighted ones. Those are the ones that you can really see where valuations are for the overall market and not only for a few sectors. And that's where we see that valuation situation surpassing what we saw in the tech bubble. And really, this is out of 15 factors, 11 of them are at all-time highs. 3 of them are basically all-time highs. And the fourth one, which is aggregate price to book, is a 91st percentile. It's not too far from all-time highs too. So, how did we reach these levels, and how do we go from here? There is a fallacy, in my view, about interest rates. Low interest rates really justify the valuations, the extreme valuations that we have in equity markets in the U.S. And when you look at median valuations across price to book, EV to sales, EV to EBITDA, or EV to free cash flow margin adjusted, you can see that the residuals, when you plot those two lines of valuation relative to nominal interest rates, is that the residual has never been so high, in other words, so disconnected from the linear regression. And that means that, yes, this is the most overvalued market we've seen, even relative to interest rates. The problem with the interest rate is that a lot of people using discount free cash flow models are only looking at this as one variable that is affecting the way we look at valuations, and saying, look, low valuations justify any valuation multiple, or any multiple you want to put into a business. I disagree with that, because when you have low yields, you also have low growth. And that's where I think a lot of investors are perhaps not seeing the greater risk in the economy going forward when it comes to valuations. When we look at financial conditions, just using the Goldman Sachs Financial Conditions Index in the red line, you can clearly see that this is as good as it gets. And in terms of, every time we have a low in this chart, basically we saw a peak in the S&P 500. I'm not saying this is where we are today, we're at a peak, but what I'm saying is I believe that there will be other assets that might begin to outperform equity markets going forward. The CapEx situation in the economy is also not improving. There's not companies are not actually reluctant to spend capital. They're not spending capital, and the CapEx estimate is still down 16% year over year. So this will have also a lot of impact in labor markets, and also will have impact in future earnings for companies. When we looked at more, in particular, this tech sector here in the US is one of the problems where we see the tech sector today, in terms of market cap and aggregate, is about 42% of the US economy, which is 26% higher than it used to be back in the tech bubble. At the very peak of the tech bubble, it's 26% higher. Another way to look at the tech bubble, I guess, if you will, this is another one, just looking at earnings yield for the top 50 tech companies by market cap. Clearly, we are very close to the levels we saw in the tech bubble in 2000. And the overall narrative that we hear is that actually these companies are very profitable, and it's a very different environment that we saw back in 2000 and 1999. But this chart clearly shows that that's not the case. Sure, the big companies are a lot more profitable than the big companies used to be back in the 90s, but that's not the case to the overall tech sector that has been actually benefiting from this situation of the pandemic and being valued at crazy multiples. Another situation that we're seeing, which also goes back to this dependency of central banks, is look at the divergence here. So the red line is corporate debt relative to assets at all-time high. So leverage is at record levels at the same time as those companies are borrowing money at record cheap yields. So this is something that has been driven by central bank policies in a long-standing period of very easy policies that we've seen so far. And I think this is another market that needs support from central banks to keep on propping up this part of the market. Here's another bizarre situation that I tweeted recently, looking at corporate bond yields. So I think more and more investors from a flow perspective will begin to really look at other alternatives to invest. And I think the precious metals will fit that budget. Now look at gold relative to a risk parity index, beginning to outperform already risk parity strategies, just like it did back in the mid 2000s. It's another double bottom, as you can see in the chart. Technically speaking, I believe gold will continue to outperform risk parity strategies, not only from the potential side, but also from a flow perspective, as I think investors will begin to sell their equities and sell their corporate bonds and sell the sovereign bonds and begin to buy gold. And if we look at precious metals relative to treasuries, for instance, US treasuries, if we're going to see a replacement of precious metals beginning to really take place in other portfolios, well, this is what I think is still ahead for us, is this tremendous asymmetric bet in where precious metals can grow a lot more relative to treasuries going forward. There is an issue that we're seeing. This is, for me, is a very dangerous divergence that we're seeing in this chart, where money supply is growing while fiscal deficit is falling apart. And a lot of the expansion of monetary base has been used to really fund a lot of the fiscal stimulus that we're seeing so far. And that's causing this crazy alligator mouth between these two lines. In my view, it's written all over this chart, devaluations of currencies as a whole. And that brings me back to what's going on with the US banks that have been borrowing money a lot more to the government than actually, or I should say, the US banks are lending a lot more money to the government than institutions and households. And for me, this is another thing that will continue to drag economic growth, but it's this dependency of institutions that are driven by the government to continue to fund fiscal stimulus at an extreme. Now, we have a twin deficit problem. We have not only a fiscal deficit, but also we have a current account deficit. When you accumulate both, that's the red line, and you see that that's inverted. And you can see that we're somewhere close to 25% relative to GDP of twin deficits. That is the highest thing we've seen and since the World War II. And the funny thing about this is that tends to gold. If you look at the white line there, you can see clearly that gold tends to outperform U.S. equities when you reach those levels of imbalance in the current account and the fiscal deficit side. And I think that gold will continue and will actually outperform equities in the following years and months. There is another dangerous convergence, not divergence this time. So there's a convergence problem where U.S. Treasury holdings along with that. So when you have a twin deficit problem, you got to think who's going to be purchasing those treasuries going forward as they continue to pile on debt. Well, the red line here is showing just the foreigners or foreign investors decreasing their amount of treasuries, while the white line is just showing the Federal Reserve progressively become the buyer of last resort of those treasuries. I think this convergence is dangerous, and I think it's the trend is also irreversible. This is not only happening in the US, it's something that is happening globally. And matter of fact, when you look at the Bank of Canada, is at a growth that we've never seen before, 400%. It went from 7% all the way to above 30% of its GDP in terms of banking assets, balance sheet assets relative to its GDP year over year growth. So a lot of central banks globally are beginning to do the same, but they're coming up from a much lower level than the US. That is causing, as they purchase bonds as they do QE, it's causing another issue, which is global negative yielding bonds. If you look at aggregate the market cap of those bonds, or the value of those bonds, you can see clearly that we're close to over $17 trillion at a record level, now 17.5 trillion, which again goes back to the support of gold and precious metals. Commodities begin to become really irrelevant for a portfolio when you can't find yield, and this is the case right here. Negative yielding bonds somewhere close to 17.5 trillion. But how do you value gold? And that's a good question for a lot of investors, and I agree. It's difficult to value and find intrinsic value of gold. One way to do that is just to aggregate global central bank assets relative to gold, and the gold is in the yellow line. It still has to catch up to the levels of dilution of money we've seen so far throughout the last decades. And I believe strongly that there will be a very high catch up here in this trade, where gold is going to have to trade much higher, given this level of monetary problem that we're seeing globally. And what we're seeing right now is a global synchronized debasement. Remember the growth, the synchronized growth environment that we had in 2017? Well, this is very similar name, but it's a global synchronized debasement problem where gold is actually rising relative to almost every currency in the world. I really doubt that this is going to reverse. I think it's a trend that will likely continue to happen. And that brings me back to commodities to equity ratio. I posted this chart recently again. I post this chart every few months because I still think that there's a lot of opportunities. My point of posting this chart a few months ago is to say that gold and silver were going to lead the way. And I think we saw that. We definitely saw gold and silver leading the way for commodities. But I think now we're getting to a point where other commodities may start outperforming. And that's when you see a turn in this chart. So, this is a 50-year or even more low on the commodities to equity ratio at a time when we have all these imbalances. It's kind of astonishing to me when you look at this chart and you think about, there has never been a better case, a more compelling case for hard assets, intangible assets such as commodities. I really think that the lack of investments in the space will lead to a higher appreciation of this ratio. Let's get into some of that, where I see we're talking about the age of risk. For me, this is right now also the age of opportunity. So let's look at this very quickly. There hasn't been any gold discoveries, large gold discoveries for the last 3 years, and those are over 2 million ounces of gold found in the world. So we're seeing discoveries fall apart. We're also seeing capex for mining companies in the gold and silver space begin to diverge for the first time relative to gold prices in the white line. And that for me is a very interesting setup. Well, as you can see throughout history, those two lines tend to follow each other very closely, but recently we see the divergence. And it makes sense that they should follow each other. As gold prices and metal prices rise, it would make a lot of those miners very optimistic and begin to spend money. And so that's when you see overspending and gold prices to collapse later on. Quite the opposite this time, where we're seeing really metal prices making near all-time highs at the same time as there has been a decade long of conservatism in this industry because of a situation where we're seeing for the last 25 years of a reputation of this company of being capital destroyers. And I think we're getting into a new era of gold where a lot of those gold miners are really going to start making money. Matter of fact, this is the first time in history, as at least as I can get data for, that gold miners have actually posted four consecutive quarters of positive free cash flow. I think this is just the beginning. No matter what happens with gold, unless it falls apart from here, those companies can really become true free cash flow machines in the following years. I think this is a very important point going forward as an opportunity. Matter of fact, when you look at the free cash flow year-over-year change, we've never seen this throughout history, 134% growth. So not only they're trading at record multiple levels of free cash flow yield, but the growth in free cash flow is also surging. And I think this is only going to continue. When you look at the actual balance sheet of those companies, you also see the median total debt to assets ratio of the miners. If they were considered a sector, it would be the cleanest balance sheets of them all. So it's astonishing to me that a lot of people thinking that those guys are still capital destroyers, but they've been through such a period of toughness where they really had to cut costs and improve their margins, where a lot of what we're seeing as well is this improvement in debt and the balance sheet becoming really strong. Matter of fact, we're not seeing capital dilution in the space as much as we've seen in the past. But from an asymmetric perspective, look at this table here, which I think are a chart that is even more important. Just looking at precious metals market cap in aggregate, it's about $600 billion. That's about 3.5 times less than what Apple is worth. In other words, one single company is worth 3.5 times. The only industry, in my view, that truly benefits from all this monetary and fiscal and discipline that we're seeing in the last few years. And I think this is just a perfect setup for this industry to really take over and become a bigger part of the market. Matter of fact, when you look at precious metals miners relative to global equity market, they only represent less than 0.6% of the global equity market. That is just crazy. It should be a much higher number as of today, and it used to be a much higher number in the past. I think we're going to go there again. So let's go to the next chart. This is just silver relative to equities ratio. I think it's also a great opportunity. Silver, in my view, is the cleanest balance. It's the cleanest. It's the cheapest metal in the world today. You can see a double bottom here in this chart. I think silver will really start to outperform equities going forward. This is just looking at silver relative to Russell 3000, a more broad way to look at equity markets. And I think it's the battle of two extremes, where you have equity markets at record valuations and silver relative to equities, relative to money supply, you name it, at pretty much record low valuations. And I think we're about to see a second wave of the Fed balance sheet, where we saw the first wave during the pandemic. I think we're about to see the second one, and that's mostly because of what's going on in the treasury market. About $8.5 trillion of treasuries will be maturing by the end of 2021. And I ask you, who is going to be the buyer? If the foreigners or foreign investors have been decreasing progressively their ownership in this market, who is going to be the buyer? It's going to have to be the Federal Reserve taking the slack. So if you take $8.5 trillion, let's just say they buy, 20% of that, 30% of that. That's a huge amount of money that will need to be diluted in order to purchase those, just like what we saw in the first wave. So I think that that's going to create somewhat of an inflationary environment, given other issues as we see commodity prices rising. The major reason why we haven't seen inflation, in my view, so far is because commodity prices have done nothing but gone lower and lower in the last decade or so. And I think that's about to change, will change the outlook for the market as well. And look at this, the level of what we're seeing in terms of dependency of central banks. We have about $4 trillion added of public debt this year so far. And it has taken U.S. economic activity back to the worst part of the Great Recession. So, I think that is it going to take another $4 trillion to get us back to normal? I think those questions are important. And I think that what we breached this time with unlimited QE and is just as impactful as the break of the gold standard that we saw in 1971. And I really believe that this is going to be start to become a problem where we're really going to see gold starting to outperform equities going forward. But I see a lot of opportunities, especially in the mining space, where I think there hasn't been a lot of people and investors participating in this market yet, especially in the exploration side of the market. But that's about it. What I'm going to have in my presentation. Thanks.
Thank you, Tavi, for that fabulous presentation. Some really great data points. I've got a lot of messages saying that it's really awesome data and great insights. So let me start off with some questions, some audience question. I'll try to, merge some questions which are relevant. So first thing up, as we see, US M1 is up at about 6.2 trillion now, and it was up about, I think, 500 billion in the last week itself. So there is an old adage saying, don't fight the Fed. I think that's the conventional wisdom. So what could be the trigger for the equity market valuations to correct? Because if this prime pumping continues from central banks across the world, do you think equities could continue to go higher?
Sure, I always can. But I think what's going to happen next year is that inflationary problem where investors will begin to really seek forms of protection of capital, where they start buying tangible assets such as commodities, and where we see commodities really begin to rise. It's almost like you're marrying two things. You're marrying the demand side with the lack of supply that has been just absurd in terms of lack of investments in the space. And that is going to lead to, in my view, inflation expectations begin to rise significantly next year. And I think that will start to become a drag on the equity side of the market. What we've seen this year has been the great disconnect, where stocks disconnected from the economy. I think that could happen again next year, but quite the opposite, where the economy is doing better, but stocks are doing worse. I think it's going to be very difficult to justify a lot of the valuations that we see 50, 60, 70 times sales for a lot of the software businesses and other high flying tech names when you have inflation expectation rising. It's important to know as well that with that issue that I noted about the treasury market, the Federal Reserve will almost be forced to purchase a lot of those $8.5 trillion of treasuries that will be maturing by the end of 2021. They're not in a position where the government can pay down the debt, and that's going to have to be rolled. As that continues to be rolled, as we've seen throughout the past, I think the Federal Reserve is going to have to participate. And in order to do that, well, they have to print money and expend the balance sheet in order to purchase those assets. And I think that will continue to give us support for precious metals and begin to really create a drag on equity markets going forward. But you do need to see a liquidity problem. And liquidity, in my view, is not so much of a deflationary problem as a lot of people are thinking. It's more of an inflationary. We're going to be coming back to the economy. The economy is going to be probably getting a short-term boom. That might lead to higher prices as well. And more importantly, remember, a lot of the indicators in the economy, macro indicators, measure price, are going to be comparing prices of March from March of this year. And a lot of things such as oil went negative in prices. So how do you calculate year-over-year change of that? It's going to have to be higher. So I think it's going to lead to some issues at the same time as the Federal Reserve has nothing to do but continue to print money. So the combination of that, where a lot of people are not seeing, is that fiscal stimulus, along with monetary stimulus, can create inflation. We've seen that throughout history. And I think this time will be no different. It's not going to be hyperinflation, but it's going to be enough that will begin to become a drag on very high multiples that we see in the market. And I think will create opportunities for value investors. That's going to be great for people that haven't done well doing actual research on businesses.
Sure. Tavi, we saw in 2008-9 when this quantitative easing in US began, and I think that there was a threat of inflation. Commodity prices went up in the first 2 years. I remember copper going back to near its all-time high and oil going back to $110 or so. But it later on, I don't think that cycle remained for a very long time. It was a very, very short cycle. So at one point, we are saying that if MMT goes on, prime pumping goes on, the only threat is higher inflation, right? So if inflation doesn't come, that means if commodity prices do not rise, central banks and governments are at will to continue this, pumping of money through central banks and through fiscal policies. So, do you think the only game in town now is central banks? And what happens to countries outside of US? For example, Eurozone cannot continue with a modern monetary theory. They can't keep on printing money because they don't have the dollar. They don't have the funding currency. So in that context, what is your view on dollar? Do you think is there a big depreciation bias for dollar in your mind?
So I've been always a dollar bull, and I've been clearly wrong this year in that trade. And I think I still am a dollar bull relative to other places. Other places have not done enough in terms of monetary dilution and fiscal stimulus. Comparing today's era with 2008 is a dangerous game because the fiscal stimulus has been completely different. We actually seen helicopter money policies this time. We actually seen people making more money not working than actually working. That never happened. I mean, that's really something completely different that has really injected liquidity in the economy in places that we've never seen before. Last time was mostly in Wall Street. This was a pretty good liquidity injected in the Main Street as well. Even though Main Street did not benefit from the large spike in equity prices that we've seen so far, but we certainly see even debt among households have dropped significantly in the last few years. They've been making more money. This is something completely new. So I think that what's going to happen is that if the economy goes back, it's not going to be a boom, in my view. Well, what we're seeing today is almost another exhaustion issue of amount of debt. It's difficult to see the economy going back to a very high organic growth again, when you have these levels of debt. Remember that first chart I showed, I think that long-term imbalance that we've seen in debt to GDP is really starting to become a drag on and a burden on growth. Answering your question, I think other places in the world will begin to also join the party a little bit more. And as we see that, I think there will be a case for the dollar relative to other places. Again, I think that every currency in the world, fiat currencies, are in a race to the bottom. And that's why I call this a global synchronized debasement. But I do think that the dollar relative to other places is perhaps a little safer place. And even relative to China, I mean, China has been even more larger imprudence in terms of monetary and fiscal side of things. I mean, we've seen China's M2 grow by about at least the size of Brazil's economy in less than a year. I mean, this is a pretty steep increase in credit. We've seen the banking assets of China grow to over 330% of GDP. That's a level we've never seen in history for an economy of that size. So those are imbalances that tend to lead to a credit bust. And I don't see this whole thesis that the dollar is going to lose its power, its reserve currency status to China. I think it's going to be, first of all, we need to clean the balance sheets of those two economies before we even talk about that. Maybe the euro is in a better situation today, given the difficulty of coming up with policies because of the structure of the euro and so forth. And that might be the case where that's why is actually a better place where they can't really agree on levels of policies that we see in the US that we can even see in China. So I think that becomes somewhat the reason why the dollar has depreciated so much is that we've seen for the first time the Federal Reserve's balance sheet surpass the levels of the PBOC balance sheet. That never happened in 14 years. So those are types of stats that I think gives you the reason why the dollar has done so poorly. But I'm still a dollar bull. I would much rather own dollars than euro, own dollars and Canadian dollars or Australian dollar or yuan, not to mention Japanese yen. So I think that all those are not comparable to the fundamentally the fundamental thesis that still remains strong for the dollar here in the U.S. But again, I still think the precious metals is a much better play than anything else, such as fiat currencies.
Sure. So if my understanding is right, what you're saying is there is a financial and currency debasement globally, and secondly, what you're saying is that because of all the MMT and QE, there is going to be let's say, a small economic revival, or let's say a shallow recovery. Does that make precious metals a better bet over other metals, for example, over base metals? Is that your hypothesis?
I think precious metals is just an easier case than copper, for instance, on or any other base metal, iron ore being another one. I just think that what's happening here is from the supply side, all those commodities look just awful. Meaning, there's certainly an imbalance of the largest mismatch I've seen of supply and demand, probably in history of precious metals. We've had silver doing incredibly well this year, and silver production is down 30%. So when you look at the miners, the top 20 largest producers in the world, their production is on a reserve cliff. In other words, their production is supposed to drop dramatically in the next 10 years or so. And that's going to have an impact. I mean, silver is being used to electrify the world. Copper is being used to electrify the world. And those are all, a lot of times you find gold and copper deposits. You find gold and silver deposits. And those metals are all together. So, the lack of discoveries in the space is happening all over. The only difference between the two is that a lot of people were seeing the rise of copper, the rise of some base metal commodities as a very positive thing or sign for the economy, when I actually think that has all links back to the inflation situation. I think it's all leading to, it's a message about inflation. It's a message that inflation is coming. And the 10-year break even, I mean, it's one of the most manipulated markets in the world. It's basically owned by this Federal Reserve, and it's rising. I mean, if there is something, that's really telling. When something is so manipulative and it's still rising, it's pretty interesting thing. So to notice. So I think that will probably be the drag on equity markets and be the positive thing on commodities. I think all commodities have space to grow. If the economy goes back to normal, I don't think that the oil is going to be trading at $40 a barrel. I think it's going to be trading much higher. I think it's going to have to be trading at $80 a barrel, $100 a barrel. What's the implication of that when you have to run an economy at zero interest rate, environment where we've seen for some time now? So the Federal Reserve is really in a corner. And it's going to be forced to print money as we see that issue with the Treasury market. So, you see what I'm saying? So it's almost like commodity prices leading to the upside at the same time as this pumping up of liquidity in the market. It's going to have to lead to inflation at some point here. So I find it one of the best opportunities to look at that commodities to equity ratio chart today again and think about, how can you get positioned for this? Because I think this is it for that chart. It's really going to begin to rise.
Sure. Tavi, let me be the devil's advocate here. You're saying commodity prices are going to go back up, right? And if that were to happen on a sustainable basis, we'll have a big commodity reflation, right? And most commodity reflation cycles cause wages to go up. Wage growth has been a big problem, right, lately. And I think in 2020, it's been a much bigger problem. That's why we see big productivity boosts globally. So if wages come back, and probably I think the earnings for most companies will also improve, across the board. So this overvaluation that we see on equity markets will probably fall, right? Does that make a case that if you continue to have loose monetary policy and with commodity reflation, your earnings for stocks also come back? Does that mean stocks could continue to outperform the commodity cycle?
That's a good question, and I'm gonna take the other side of this, because once the equity market, not the treasury market, begins to see the eyes of inflation, I think that's when you're going to start seeing issues in the equity market in the U.S. The U.S. is seeing this as there is no chance for a deflationary bust. What you can get 20, 15% decline in the market, what do you think the Federal Reserve is going to do? I mean, it's pretty clear. They're going to print more money. So, I think the equity markets, it's aware of that, unless it's a crazy liquidity problem, a solvency issue in a major institution. It's possible to happen. But given the level of hand holding we're seeing from governments and central banks, it's going to be difficult. I mean, any issue is going to be more money printing. So it's making the equity market already be aware of this capability of central banks to do what they're doing. Now, what about when actually inflation begins to rise and begins to limit this type of intervention that we're seeing? And look, fundamentals have to improve a lot to make the equity market cheap. And I mean that because we're about 60% higher than the median valuation historically. So in normal terms, equity market would have to fall about 50 to 60% to go back to median terms. But we know the equity markets and markets in general work in a pendulum. So in other words, we're probably going to see a much steeper decline than that when things really unravel. I'm not playing for that. I'm not playing for the 60-50. I'm just putting into perspective of where we are in valuation. So, you would really have to see a major improvement in fundamentals from here that has been incredibly depressed in the last few months. And remember, for people that think that fundamental growth is going to go back to where we were in 2019, that wasn't a pretty good story either. I mean, we were seeing profits for companies already contracting back then during that time in late 2019, before the whole pandemic issue started. We're seeing Japanese GDP was already contracting. So a lot of issues back then already happening.
Sure. Let me go back to gold. You showed a chart where you showed global central bank assets, and you said that probably gold is undervalued basis that model. Even our own macro model shows gold is pretty undervalued. And also gold's cousin, the silver, you showed, I think it's a fabulous chart where a 20-year chart where double bottom is in place. What's your target on both gold and silver? Right now, gold is at 1850 or so. What do you think should be the next 3-year trajectory for gold? Because Indians love gold, we are the largest consumer. Everybody in India is an investor in gold, and I think people would love to know your outlook.
I know you guys love gold, and that's great. You guys understand the need for monetary protection and destruction of central bank policies that we've seen throughout history. I'm from Brazil, and I get it too, and I think Americans still don't get it fully the picture. I don't have an actual target for gold, and I think that's a moving target. Why do I say that? Because I'm not a gold bug. I think this is a macro call. I wasn't a fan of gold years ago. I am a fan of gold today because I don't see any other alternative for this. I really think that we reached a point of debt where it has to lead to higher tangible asset prices and lead to inflation at some point because of the fiscal stimulus married with the monetary. But to answer your question, I'm going to try to answer. I'm going to say at least a double from a few in the next 12 months or a few years. And I hope it's a gradual increase. I hope it's not a bubble like we kind of saw back in July with silver going a little bit too much. It was rising, 7-8% a day for a whole month. And that I think was a little bit extreme. And volatility is not the type of thing that I would say a lot of pension funds and large allocators would appreciate. I think silver is a little bit more clear of where it's going to go. I think silver will be, at $50, in the next 6 to 12 months, and it could be much higher to all-time highs very soon. So, those are very, very moving targets. If there is a change in the macro scenario what causes central banks to begin to contract their balance sheets, I'm going to change my view. So, as of now, I can see a double in both commodities for the next 12 months. And in next 12 months, I'm gonna reassess that view, and I reassess it on a daily basis and see where we are. If negative interest rates and the real terms begin to fall, as we've seen as a major driver for gold and silver prices, and they have been. Why? Because of inflation expectation that's been rising a lot more than nominal rates that will continue to support gold and silver higher. So yeah, I'm not a gold bug. I just see this as a macro trade, and I really think that there's no way around this but monetary dilution going forward, and that's going to lead to things like gold and silver to a much higher levels, even Bitcoin.
Sure. Tavi, I'm going to come back to emerging markets question, which I think is very important. But let me put one more question. Has Bitcoin stolen gold's thunder this year? What's your view on cryptos? And because lot more people have been more active on Bitcoin, and I think the narratives are just too large. Has Bitcoin stolen gold's thunder?
I think I'm a fan of both assets, as you know, but I would say people saying this have missed their math classes in high school, because gold went down about 2 trillion, lost $2 trillion or so of value in the last few months, $2 trillion, and Bitcoin gained about 200 billion. I'm just talking numbers, about $200 billion of increase in the Bitcoin market cap. So the drop in gold would be only explained by about 10% of that rise in Bitcoin. So I don't think it has anything to do with that. Do I think that Bitcoin has a higher potential than gold in terms of return? It's just an unfair comparison on very different types of markets in terms of size. Bitcoin should be compared with an equity company. I mean, Nvidia is the size of Bitcoin. In terms of performance and so forth, it shouldn't be compared to a 9 trillion giant market such as gold. So there will be still the need for pension funds that have done nothing with the gold space, basically, with the record low allocation of gold in their portfolios. I think that we're going to see a major increase of that, given the exhaustion point of the risk parity strategies, which is something that has been very popular, and in my view has also driven, along with central bank policies, the valuations we have reached so far in the last few years in terms of equity markets. So it's all linked. But no, the answer is I do not think that Bitcoin stole gold's flows in a way where it really damaged the gold market. I think what JP Morgan put out today is just absurd. And we all know JP Morgan's probably doing quite the opposite of that move anyways. So it's probably meaningless regardless.
Sure. Tavi, you come from Brazil, and I think the economy probably suffered a mid-income trap for a while, and I think our own problems, economic problems here in India, are not very different. To put into context, I think because you're saying there is going to be a commodities rally, which historically has favored emerging markets. Okay, and if you put that into perspective on your views on China, which, as you say, is fiscally and monetary been pumping a lot more. Probably, are you saying China will slow down a bit going ahead with what it's doing right now? And if that's the case, what emerging markets would do? What's your view on emerging markets?
I think it's all linked to what you just said in terms of China is one of the largest importer of commodities in the world today. If commodity prices go higher, that's going to affect China. And it's all linked to my views about China, where we see issues with aging population. We see a problem of credit imbalance relative to its economy size. We see a very overvalued currency, the yuan. We see an economy that has been trying to or thought about opening their capital account and quickly realize that the issue that it's going to be in terms of devaluation, that will be a natural development, very similar to what we saw in Japan in the 50s. So there's a lot of things that are linked to what you just said. There's a chart that I've been looking at for some time now that I think it kind of explains part of the story that you just asked. Whereas if you look at the MSCI Emerging Market Index relative to Commodities Index, you can see that they follow each other very closely all the way to 2011. Then after that, there's a disconnect where actually emerging markets begin to rise, but commodities fell apart. So today we have commodities coming off a base that is just absurdly low. but not emerging markets. It's not like emerging markets are cheap. They're cheap relative to developed economies, as they should be. There is a ton of risk relative to developed economies, but I do think that there's an issue with some currencies. Brazil, for instance, taking the relative to the federal funds rate here, which is called taxa Selic. It's today at a negative real rate today. So relative to inflation. So those are things that we have never seen emerging markets do. They're acting like developed economies. So I don't think that those are as cheap as a lot of people think. I think that commodities are cheap, and sure, some emerging markets may benefit from that. But I think that the asymmetric opportunity doesn't start from a much higher level as a lot of emerging markets are relative to the commodities price. Commodities price for me is the real opportunity for the next few years.
Sure. So maybe a last question before I move to some more subjective topics. Tavi, what is the best way to play commodity cycle? Is it gold mining stocks or let's say an ETF? What is the best vehicle?
That's a good question. So I think a lot of investors, and I'll include myself in that, when you start looking at gold, the first thing you look at, I mean, you're not, the return is not on gold. If you're looking for protection, that's your asset. Gold is your asset. If you're looking for growth, silver is one of the places where I think there's a much higher potential of price appreciation in the next few years. Okay, well, if that happens, even if gold just stays where it is, it doesn't need to move. Miners are supposed to be making a significant amount of money and really generating free cash flow for the following years. This are businesses that will become incredibly profitable, and they are already profitable, incredibly profitable in the following years if this scenario continues. So most investors have been looking at the bigger names, the Kirklands, the Barricks, the Newmonts of the world, the Franco-Nevada, and the Agnico, and that's fine. I think those companies are going to do well. They should do well given the scenario. But given this reserve cliff situation where we're going to see a lot of companies depleting their reserves going forward and having production being challenging in the following years, where mine life is decreasing dramatically and companies will be looking for new deposits when you have not seen any new discoveries, not only because of lack of spending, but also because it's geologic more challenging today to find gold as it was 20 years ago. So what's going to happen, in my view, is that one segment of the industry that not a lot of market participants tend to look at is the exploration side of it, where it requires a lot of knowledge about geology. We partner with a geologist called Quentin Haney. I think he's the most successful geologist that in the world today in terms of exploration, that was able to figure out Foster View's mine and was able to be involved with that discovery, which was one of the most important discoveries in the gold space in the last decade or so. So our focus is to take up that discovery curve again. And our goal is to be, we've been doing a lot of activism in the space, investing in a lot of different deposits all over the world that we really see value in terms of finding gold rather than buying gold at $1,800, $1,900 per ounce. Well, we can find a lot of gold in those places in very economically viable regions for about $100 an ounce underground. So for me, that's interesting, and I think that those stories are going to be very important in the following years, as those big miners are going to have to be looking for those large deposits with very high grade discoveries. And I think that that's where the real opportunity is ahead, where you can buy a company that's worth literally 10, 15 million, and it can be worth about 500 million in a few years. So we've been buying a lot of we find, one of the most prolific deposits in the world today in Canada, some strategic areas of Canada and the US, also in South America and Australia, and avoiding some other more dangerous places. in terms of operating a mine and exploring places in general. Brazil is one good place where we've been invested to. And I think this is where the opportunity lies ahead in terms of asymmetric bet. About 95% of our portfolio today is in exploration side of the industry. Again, I do think miners are going to do well, and for the people that don't have the knowledge of going there and really navigating that part of the industry, that's fine. I think that the Newmonts of the world will do just fine. They're great companies that have really consistent free cash flow, great mines, and they're probably going to be great investments in the following years too.
Sure, sure. Thanks for that. Tavi, 2020 has been a crazy year, huge volatility, and I think you've performed really well this year. Since March, what have you traded? How have you handled this volatility? Take us through your thoughts over the last 6 months.
Well, I thought the market looked pretty toppy back in the beginning. We had a lot of shorts, and our shorts are working terribly against us. We came in the beginning of the year, pretty high volatility with our shorts not working. We added to our shorts. We thought that the timing was there, and we began to really bet on the shorts. It happened to be the pandemic. It happened to be the right time, and we made a lot of money on the shorts. When the shorts started working and the market was down 25 or so percent, not as low as the 30, we began to unwind some of those shorts, especially in the names like hotels and so forth that were down, 50, 60%. So we began to kind of unload some of those shorts. Not all of them. We kept, we thought we're probably going through a Great Depression type of deal where lack of liquidity was going to completely destroy the market. But then the Federal Reserve came in, and that's when we thought, look, if there is one industry that should benefit from all this, is the mining space. So we really began to buy and trade a lot of those names. We bought a ton of mining companies. I think most of our performance attributes to that opportunity that we saw at the time when silver went down significantly, gold went down significantly, and some of the miners that we bought were down 70% at the time. So we began to buy everything. I remember the brokers asked us what happened. That we're just on a buying spree like crazy, just buying every miner in the world. And trust me, we did not hit the time the bottom. We started buying maybe a week before, and some of those names went lower. But for us, that was the timing. We wrote a letter about that, and that's really what drove performance all the way to where we are today. Then we started to switch our focus from the large miners to more of the real exploration parts of the market. And we began our strategy of actually doing activism and becoming the trigger for a lot of those companies in about July and August. And that's when we sold most of our miners and began to buy a lot of the exploration names. And then 95% of our portfolio stayed in the exploration side of things in terms of the precious metals positions. And then what we saw from there was that our portfolio was able to stay up about 90% of return in those 3 to 4 months, while precious metals actually peaked and silver peaked and began to fall, where we saw the consolidation mode that we've seen so far of a decline of about 14% in gold, and we're actually managed to be up. Where I think there's a lot of opportunities still in this market. I mean, it's just the beginning. And now we're starting to look at warm up to other places like oil. I think oil might become a good investment for Crescat in the following years. It's not something we have currently, but something we're looking pretty deep as an investor. Another macro call, as I think we're going to see more of an inflationary environment next year, very different than this year. So if we do, I don't think oil deserves to be where it is. So those are some of trade ideas. I still like the exploration names. We're here to stay. We're probably going to be in this for another 3 to 5 years. I don't think this is the beginning of a cycle. When you look back in history, gold cycles tend to last about 10 years or so. We're starting in 2018, 2019, arguably for the miners, not for gold. Gold began a little earlier. I think we have long ways to go here. So I think what's going to happen is that a lot of the miners will begin to be seen as the growth stocks in the market. And I think investors will figure that out because that's going to be the only side of the market growing fundamentally versus any other side of part of the market today. So lots of opportunities ahead, but that's kind of the wrap up of 2020, how we manage. I mean, there's still, good 20 days as we've seen so far this year. 20 days can create a lot of damage. So let's hope this is going to be a good year.
Nice. I hope so. So last question before I let you go. What are the books that you read? Any recommendations? How to, get up the knowledge curve? Any specific ideas that could help all of us to develop our own macro models?
I read a lot of books, and most of actually I go for runnings and for runs, and I like to listen to books usually. Um, I have a few, but I spend most of my time looking at macro data and building models, as is my true passion to actually completely mute the noise of watching the news or looking at the news and just building my own narrative. And then I like to see what's going on in the news and see if there's divergences in views. And that's where I end up finding a lot of my charts that you just saw here. In terms of books, let's see. I really like the fourth turning book from Newhow. I think that's a really good book that explains a lot about what's going on in the world today and what happened even in the world a few years ago. It was written in 1990 in 97. So it's quite incredible how a lot of the things that he talks in that book played out perfectly. I like Market Wizards a lot, just kind of understanding how different managers tackled in a different way in terms of their investment process. I became a person that really appreciates that. I think it's an art, and I think it's important to learn from that, from different ways that work for different people, and perhaps that can apply to your own process. So I'm always open minded and reading those. Recently, I read, not recently, I guess a few months ago, the Bitcoin Standard, which I think a lot of people, because of the title, would think it's a lot about Bitcoin. It is a lot about Bitcoin, but it's a good book to read about history of the monetary system as well. I think there's a lot of good chapters there to learn about what's going on, and even though I disagree with some of the takes there, I think there's a lot to learn about what's going on with the gold environment in general, and why gold is seen as a currency for centuries. So it's a good book to remind you of that. Anyways, there's probably more books in my. I just don't have it in my head right now, but it's I enjoy reading books in general and my time when I'm off. But I also do a lot of reading even during market hours. I think it's important to mute yourself from the noise, and that's one of the most difficult things to do in the investment world, is to put yourself out of the emotion of what's going on every minute with price action. So I try to do a lot of that, and I think that's very helpful. And writing letters is such a good way to put your thoughts together and really think about it, and make sure that you don't have any flaws in your arguments. There's always flaws in any argument. I can bring the entire bearish thesis for gold here if you wanted to. It's important to know the other side of the trade as well. So I spend a lot of time doing that as well.
Sure. Thank you, Tavi, for your time today. We've been following your thoughts, reading your letters, and I think we'll continue to do that. And we would want you to come to India once things are settled, and come and speak to our investors here as well. Thank you for your time. It was fabulous speaking to you today.
Thank you very much for having me. I would love to go to India, so I might take your invitation, and I might go there whenever this pandemic situation gets better. So thanks.
Thank you. Thank you, everybody.